Welcome to the Explainer. Look, if you're an administrative or payroll professional, you already know the feeling. The calendar flips to December and bam, the weight of that federal year-end payroll sprint just looms right over you. It is stressful, right? It's filled with complex reconciliations and strictly enforced compliance rules. But today, we're framing this massive undertaking as your ultimate tactical survival mission. We're going to transform a giant mountain of Canada Revenue Agency regulations into a streamlined, highly focused checklist. So, I have to ask, is your team truly ready? If you're hesitating even a little bit, hey, you're not alone. The stakes here are incredibly high. The sheer chaos of missing deadlines or miscalculating statutory deductions opens your entire organization up to severe CRA interest charges and really painful financial penalties. Every unlogged manual check, every missed taxable benefit, it all comes home to roost right now. That's exactly why we're building a shield against these threats using a comprehensive 4-part checklist derived directly from federal guidelines. Here is your mission briefing. We're going to tackle Phase 1, Startup Prep. Then Phase 2, Payroll Practices. Moving into Phase 3, Rules and Penalties. And finishing with Phase 4, Crucial Communications. Breaking this massive checklist into these 4 distinct phases turns a bureaucratic nightmare into a totally manageable, step-by-step process. Okay, let's dive right into this with Phase 1, Startup Prep, laying the groundwork. You know, a successful year-end doesn't actually start in January. It starts weeks, maybe even months prior. First up, you've got to create a dedicated year-end reference file for your specific filing procedures. Then, download the latest CRA forms, because let's face it, rules change frequently. But the real magic is in Step 3, organizing cross-department meetings. Year-end payroll is absolutely not a siloed event. You need total alignment between your Management Information System department, HR, payroll, and accounting. Setting expectations early on is what prevents those massive data bottlenecks when you're down to the wire. All right, so with your teams totally aligned, it is time to execute some essential startup action items. You need to produce those preliminary year-end reports and make sure you reset your accumulators if your specific system requires it. Crucially, you've got to proactively update limits for the new year, things like registered pension, RRSP limits, and workers' compensation maximums. Communicating these new limits directly to your MIS department prevents a domino effect of cascading calculation errors from corrupting your data later in the mission. All right, moving on to Phase 2, Payroll Practices, the core tactical work. See, accuracy has to be a year-round habit, not just a December panic. Reconciling your payroll tax accounts regularly, meaning comparing your internal tracking against the CRA's PD7A statements, is completely non-negotiable. If an employee got a manual bonus check back in October, or maybe a direct deposit was reversed, those absolutely must be updated in your records immediately. If you wait until year-end, you risk discovering major CPP or EI contribution errors when it's too late. You also need to make sure you carry forward accrual balances for the new year, like loan balances, garnishments, and vacation time. So the crucial point here is $100. That is the exact penalty the CRA is going to charge your organization per occurrence if you fail to make a reasonable effort to get a valid social insurance number for an employee. Seems like a tiny administrative step, right? But ignoring it creates a direct, completely unnecessary financial bleed for your company. Now, if you absolutely cannot obtain this in, you still file the return, but you must be able to prove you made a reasonable effort to get it. And that actually brings us to a piece of dreaded payroll jargon that you want to avoid at all costs, the PIER. That stands for Pensionable and Insurable Earnings Review. Basically, the CRA triggers a PIER if they detect that an employee's CPP or EI premiums don't actually match the expected calculations based on their earnings. To avoid this whole investigation, double-check your calculations meticulously before filing, ideally using CRA-approved checklists. Processing those taxable benefits on a strict pay period basis throughout the year is for sure your best defense to keep the CRA off your back. Now, before you finally close the books, you've got this micro-arc of final adjustments to lock down. Account for workers' compensation awards reimbursed to the organization, ensure any miscellaneous accounts payable payments are entered into payroll, and carefully verify specific pension adjustments. You also have to true up those taxable benefits. For instance, if an employee has personal use of a company automobile, their benefit was likely estimated during the year. Now, you actually must adjust it based on the exact kilometers driven. Only then can you accurately produce those T4s. Which brings us to Phase 3, Rules and Penalties, Mitigating Your Risk. And this brilliantly illustrates what I like to call the ultimate timing trap in year-end payroll. If you make your payroll adjustments after the last pay is produced, but before the final remittance due date, smooth sailing. You simply include the statutory withholdings on those adjustments with your final remittance. No interest, no penalties, no problem. However, making those adjustments after that final remittance due date enters a world of pain. Any amounts due to the CRA at that point will likely attract late penalty charges and compounding interest. Timing is absolutely everything here. So, to mitigate those risks, you want to strictly follow these 3 steps. First, lock in your filing method early, whether that's paper, T4 web forms, or electronic. Second, identify all of your hard deadlines, noting especially that T4s and T4As absolutely must be filed by the last day of February. Third, establish some ironclad internal procedures for amending or canceling slips. Knowing exactly how your team is going to correct an erroneous manual T4 or T4A slip will save you from a massive last-minute panic. Finally, we reach phase 4, crucial communications, managing expectations. See, year-end requires a massive communication web. Because honestly, even perfect math fails if the rest of the company is kept in the dark. You must notify your auditors, finance, and HR about taxation rules. You need to send notices out to department managers, timekeepers, and union executives detailing the final payroll schedules and strict deadlines. Furthermore, communicate directly with your employees. Send reminders for them to file new federal and provincial TD1 forms if their personal tax situations have changed. And critically, remind all of your commission employees that a new TD1X form is required by January 31st. Keep everyone informed, and you keep everyone compliant. Now, just when you think you're absolutely exhausted from finishing up the current year, the truly strategic payroll professional pivots to look ahead. You have to review next year's payroll schedule to identify any calendar anomalies. For example, if you run a biweekly or weekly payroll, you need to ask yourself right now, are there 27 or 53 pay periods next year? And that leads us to this vital, proactive question. If there are 27 or 53 pay periods next year, how will the annual CPP pay period exemption be handled? It forces you to think critically about how the upcoming calendar is going to impact taxable benefits, deductions, and your entire system setup. By mastering the startup prep, locking down your payroll practices, respecting the rules, and executing crucial communications, you don't just survive the year-end payroll sprint, you completely master it. Thanks for joining me on this explainer, and good luck out there on your payroll mission.